Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 14th of June 2019 and we are asking the question, do millionaires know something we don't? Now this is a fun question with an interesting undertone. So before you hear it, give us a thumbs up. As we fear by the end, you may give us a thumbs down. So if you give us a thumbs up first and then a thumbs down, they'll counteract each other. No, seriously though, we are just reporting on a CNBC report published on Wednesday by Eric Rosenbaum, who gives us a perspective of how some of the wealthier in our society believe is where they should still put their money. And unfortunately for us stackers and collectors, it's not in gold and silver. Well, not yet anyway. Now, before we are accused of being CNBC supporters, let us make clear we are not. It's just that this is an interesting survey which was carried out in May, and we felt in the interest of putting both sides of the financial debate, it is worth at least covering. Now, this is the headline that they launched with. Quote, CNBC's latest Millionaire Survey finds that America's wealthy remain confident in stocks and the economy, even as trade wars persist and President Trump and the Federal Reserve spar over interest rates, unquote. Now, the key points from the survey indicate the following. 1. The stock market is near an all-time high, and wealthy Americans think the good economic times will roll on, boosting their investment portfolios through the end of the year. 2. The CNBC Millionaire Survey for spring 2019 finds that individuals with $1 million or more in investable assets expect a rate of return from the S&P 500 of at least 5%, and many expect stocks will go even higher. And 3, millionaires do not expect to make portfolio allocation changes over the next 12 months. Now, everyone who has followed this channel will be aware that we've produced numerous YouTube videos and articles highlighting that the world is entering into an economic slowdown, which may result in a recession. With recent job numbers disappointing, yield curves have inverted, and stock markets are near an all-time high. We have also pointed out that gold has had one of its best runs in a couple of years and is today standing up $15 from Friday's close at $1,355, and despite that being up 4.5% already this month, it could be going even higher. So what does this report indicate that the rest of us are missing? Well, first of all, the survey was carried out with 750 affluent individuals with investable assets of more than $1 million. What is interesting is that it shows that the market sentiment of these wealthy individuals has improved since the last time CNBC's biannual survey of millionaires was conducted in the fall of 2018. 40% of them believe that the S&P 500 index will finish the year up by at least 5%, with 8% of them suggesting it will rise above 15%, and 17% of these millionaires believe that markets will rise between 10 and 15%. Of the total, only 15% predict that the stock market will show an annual decline. Now, against this backdrop, we have to bear in mind that the S&P is already up by 15% this year. So it will be reasonable to suspect that if they are right, markets will end the year at similar levels to their current position. 23% of these individuals believe that the economy will be weaker by the year end, while 39% think it will be stronger. and 38% believe it will remain the same. So the majority are the status quo or stronger. They also feel that the Fed will not aggressively cut interest rates this year, though they haven't ruled out a small cut, with 59% saying that rates will remain as they are now, 35% they will go higher, and only 4% predicting they will go lower. Now, there is, admittedly, a wide disparity between these millionaires and what traders are anticipating. The majority of those surveyed do not expect to change their portfolio allocations over the next 12 months, and equities continue to represent the largest portion of investable assets among all age groups surveyed, with technology stocks being the favourite amongst 25% of them. Now, whilst the age of these investors indicates a trend to either overseas stocks or bonds or money market funds, US stocks are still by far the most popular asset class for investing dollars at every age. So what about precious metals? Well, many of you will be surprised that although we have frequently argued ourselves, and we tend to be cautious, that a 5 to 10% exposure is sensible for all investors with a reasonable portfolio, only 1% of these individuals are saying they plan to allocate portfolio dollars to precious metals, and this is regardless of their age. So do they know something we don't? What do you think? Are these people living in a bubble and refuse to admit what is going on? Or are they perhaps more tuned in than the rest of us and believe that things are nowhere near as bad as the media paints them out to be? A third option, which is also a possibility, is that we could all be right, in that we could have a situation whereby rates do go lower, which boosts stocks, but also boosts precious metals, as the cost of holding them diminishes in terms of interest lost from investing elsewhere. Do share your thoughts. Finally, as a heads up to those who are paying members of the Inner Sanctum, the webinar conducted last Saturday is now available either on the website or on our Discord channel. We have provided links in the description box below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.